I think from a development point of view, it's relatively expensive, and we don't do, it's the one area that we don't do from M&G Investments rather from the real estate business. We do look at it, we help them, we talk to them about residential debt. They will only provide it on standing stock because the perception is that it's too risky if they're going to go down the development route, because we're not in that space. Development debt is expensive relative to standard debt, clearly. Unless people have got very large balance sheets, it is quite hard to come by. And that, again, is the area that people with funds are getting an element of traction with the developers. The mechanism by which people have been operating in the UK to actually build schemes has been to forward sell individual properties to overseas investors and then use that money to then put it beside debt in the UK to then develop out their scheme. And that's one of the reasons why what's happened in central London has happened, of schemes being sold overseas, etc. We've seen a huge proliferation outside of those areas because you can't sell schemes in, well, the location's getting wider, but because you can't sell schemes in Guildford so easily to a Hong Kong investor, they're not really getting built in the same way, and certainly not in the same scale. So it's expensive at the moment in relative terms.
Any perceptions from the continental European
Well,
side?
for Germany, I can say that as more equity is coming to the market, and as more players that are buying pure equity buyers are coming to the market, there is more and more competition on the lenders side at the moment. So the LTVs are going up. They went up in 2014. The imagination is for standing stock for portfolio transactions. The LTV will rise in 2015 again. The margins are they are low, but they might go down. They might go down as well. So there's not at all a problem to get financing at the moment for standing stock. It might be a bit different for development in Germany as well, but I don't see a shortfall in debt for Germany.
I think leveraging a product or investment is most investors are looking for. If you look at the proportion of equity investors to investors that are looking to leverage, you will find that most investors will like to leverage because that's how you get the returns that they're looking for. So I think generally there's a wide analysis or perspective or outlook to trying to attract a lot more of that debt in that sense. And accessing debt, as in terms of developing and whatnot. I mean, I don't know what for the UK, but in Spain has been particularly very complicated, and I say the same for Portugal or Italy and whatnot. Just because the risk perspective and whatnot. And I think now we're starting to see international banks, funders coming back into the market. We're seeing how banks are actually not just financing the actual construction of it, but actually even looking into financing part of the land as well, which is significant, and it's also another sign of the recovery in that sector in that sense. But I think we've seen the equity coming to the market. We've seen that the fundamentals are obviously recognized, and the earlier part of the type of money to obviously come into the market. And I think now we need to say the debt side in that sense, couple itself and make sure a lot of these developments take place.
I would say looking at the fund level as an institutional investor. If you have a core value add strategy with, let's say, not excessive LTV levels, regulatory they are bound to around 50% if you go for German special fund, or even going forward in 2 years' time also for most of the Luxembourg structures you have an LTV of around 50%. It's a competitive financing landscape. It's no issue to get, let's say, good, attractively priced debt, no matter which country you're investing in. It might be a little harder if you look at Ireland, but it's still a country where you can get the financing without a big issue.